we are really excited that we can get to learn something today. And of course, watu wanalia njaa in terms of hakuna pesa, but let's know if you have some few extra coins, where can you invest this money? And a very warm welcome to you, Justus. I can already see that you're online. Karibu sana. Justus is the head of product at the Capital Markets Authority. We really want to get it from a regulator's perspective. How can we dip our fingers into the securities products or instruments of investment?
Thank you so very much, Mudhoni, for this session. My name, as Mudhoni has said, is Justus Agoti. I'm the manager in charge of product development and uptake at the Capital Markets Authority. So I'm going to take you through a bit about capital markets and how they work. Capital markets are a very interesting market. We have commodity markets where you exchange all kinds of products, be they oranges, tomatoes, and others. Essentially, these days, a market is defined as a platform, not necessarily physical, where exchange of products, commodities, or even services takes place. Once we understand it as such, you would have made a huge step in understanding exactly how capital markets operate. Capital markets are a platform for exchange of funds. So you would find there are people who have excess or surplus funds, and there are others who are in deficit. So markets, specifically capital markets and even financial markets, which I will explain about a few minutes from now, stand in between the people or entities, organizations that require funds and those that have extra funds. Those that have excess funds are the ones we call investors. And therefore, you are either called an investor or a lender. You lend to the entities that require the funds. Then, of course, there is the borrower side. Those entities, organizations, individuals that require the funds from you. Now, in order for them to get those funds, of course, there has to be a process. There has to be a rule, or can I call them rules of the game. Now, financial markets are very broad. Now, when you're borrowing for less than 1 year, those are what we call money markets. When you're borrowing or lending for more than 1 year, those are what we call capital markets, because capital markets are usually seen to be patient capital, meaning you lend someone for a longer period and you value, or can I say you charge a fee on the basis that you're going to lend for that longer period. Short-term markets, or what they call money markets, are usually the forte of banks. So banks usually lend more than 1 year, but usually you would find the rates are usually far higher than what could be offered by capital markets. You can see at the center, we have financial markets, which are essentially platforms where the exchange of funds between those who have and those who don't have happens. The money lending app is there to provide you with a platform for you to borrow. The assumption is the company that has put up the app is going to bring together those who have the money and those who don't have. The financial markets is an umbrella term that refers to both money markets and capital markets. I was trying to put some of these markets into the various segments, whether they are capital or money markets, depending on the period within which funds are either lended or borrowed. Okay, and that is where we have foreign exchange markets. For example, if you go to a forex bureau in town today, if you have a few dollars, they'll give you Kenya shillings, or if you have Kenya shillings, they'll give you Uganda shillings, depending, right? Those are short-term markets for funds. They are also called money markets. So in that same group, we have insurance markets, we have commodity markets, which I said belong to both capital and money markets, depending on the tenure that we are talking about here. We have money markets there, as you can see. These ones, these are essentially short-term. The long-term ones is stock markets, bond markets. These belong to both. Then derivative markets also belong to both, but mostly they belong to the short end of the market, which is money markets. Then we have futures markets, which are in capital markets, exchanging products within a period of more than 1 year. Money markets, a branch of the financial markets where funds are mobilized, and they are mobilized through financial instruments. Ultimately, there is high liquidity. High liquidity meaning money changes hands very fast. Within a short time, money has changed hands very fast compared to capital markets, which are are more long-term, more patient capital. The levels of liquidity of changing hands of money or funds between parties is not as fast as in the money markets. They all belong to the umbrella that is financial markets. What we are seeing there is now a subdivision. And if you did some biology, I remember us learning about divisions. So this is just trying to classify so then we can drill down to some of the technical areas around capital markets so we're able to understand what we're trying to do. So at the very top, as you can see there, we have financial market. But we said financial market can either be a money market, short-term, less than 1 year, or a capital market, long-term, or more than 1 year. Now, let's leave aside money market for a while because we said this is the banking sector. And the banking sector has its own regulator, which is the Central Bank of Kenya. And across the world, banks have their own regulator, usually a central bank or an equivalent institution that oversees operations within the banking sector or within the money markets. Then we have the capital market, which is our focus area today. And what we are saying here is, for capital market, it's also subdivided into two. We have the primary market and we have the secondary market. And I want you to note so then we can work together in this. Now, a secondary market is also subdivided into two, right? It can either be a stock market or an on-exchange market or an over-the-counter market. So let's, for example's sake, assume that Muthoni's company is worth 100,000 shillings. So she has a capital of 100,000 shillings as the amount that she has used to start a company. Now, she has to divide this company into shares and then value each share that should be equivalent to the value of this company that we are talking about. So for example's sake, let's assume that each share of this company is 2 shillings, all right? So in order to know the number of shares that have been created, in order to give to each of the directors of the company, then of course you divide the amount of capital by the price per share. Then you'll get the total number of shares that this company has. So that then we can cut down on the zeros. Let's just assume that her company is worth 100 shillings. It means that if each share is 2 shillings, then Muthoni's company is having 50 shares. That's her company. A company that has 50 shares, each is valued at 2 shillings. Now, let's, for example's sake, again, go ahead and say Muthoni has a partner in that company who has an equivalent number of shares, which means these 50 shares we have, we divide them into two so that each has 25 shares. You might have it that she wants to expand her company, but she doesn't have the capital that she requires. So she wants to become a borrower. Initially, she has 100 shillings. She wants an extra 50 shillings in order to make a capital base of 150. Remember also that initially she had 50 shares because it is 50 shares times 2 shillings, which makes it 100. All right? Now, it means that if she wants an extra capital of 50 shillings, and we know that each share is 2 shillings, it means that you will have to get 25 more shares into the company by either bringing in a new shareholder or tapping other sources of capital. Now, capital markets will come in and help her to raise the amount she requires so that she can expand at the pace that she wants. And the decision as which approach to use depends on, one, the cost of capital. How much is it going to cost? Two, the convenience and the speed at which she's going to get this capital. Yeah. Three, what is the repayment going to be like? Now, if she goes for a bank, number one, the bank will require collateral. Number two, the bank will require a business plan. Number three, the bank will require, the repayment to be in certain ways, because we said banks usually focus on short-term capital. Perhaps they'll require her to pay within 1 year. Now, this is where capital markets come in, and this is how they come in. One, so Muthoni can go ahead and issue shares to new shareholders. And how she's going to do that is by, first of all, having it passed as a resolution in the board of the company that this is a decision we have made. We want to raise 50 shillings more. And this has been passed by, say, 75% of the board, so we can go ahead. Once that has happened, she has to approach market intermediaries within capital markets who will support her and do what we call hand-holding by preparing a document that will highlight the key details on how she wants to raise the funds and where she wants to deploy those funds. Okay, that is in the primary market. So once she has put together the documentation, she will come to the capital market, and do what we call an IPO, initial public offer. Here is where you sell your shares for the first time to prospective investors. So once those investors come to your company as people who have purchased shares of Muthoni and Company Associates, then they become part owners. So if, for example, we assume that there was an extra new shareholder who has come in, so the ratio will be 25 to 25 to 25, because the capital that you have raised is 150 shillings when you totalize plus the initial capital that already was being had by the company. So in the IPO, once you brought in the new shareholder, you do what we call a listing. A listing means you have put aside a percentage of your total shareholding, so then anybody can purchase shares at any given point in time, so long as the market is open. So in our case, we have what we call the Nairobi Securities Exchange, and it is the one where you list a company through what we are calling an initial public offer. Now, once that happens, remember we had said each share is 2 shillings. Once listing happens, that share price could either go up or down, depending on how the company is performing and the perceptions of the investors who will be coming in to purchase these shares at 2 shillings per share. So, for example, Muthoni can decide to float, say, 25% of their shareholding. All right. Remember, the shareholding is 75 shares. So you can calculate and do 25%. Those are the ones that have been put up for sale at any given point in time to the market. Now, Muthoni does not have control over who is going to purchase those shares or who is going to buy, so long as once she declares a dividend, the dividend will be paid to the person holding the shares, irrespective of who held those shares in the past. That's what is interesting. And that is what encourages what we call liquidity. So it is the fact that these shares have been floated or listed, if you use a technical language, means that this company has now opened itself up to the public. And the public waits and watches that company to see what are the signals, what are the guides to show how the company is doing. A lot of times, a company's performance is determined by the perception of the majority of investors. So you would find this share going up by, say, to 3 shillings or coming down to 1 shilling, depending on how is the company being managed, who are the directors, what kinds of borrowing has the company done. Are there any risks in terms of the industry within which this company is operating? If there are risks, sometimes that gets incorporated in the price of the share price per share. So if you had bought this share at 2 shillings and you realize after 2 weeks the share price has gone to 3 shillings, then you can comfortably sell. And that happens in the secondary market. So in the primary market, it is when you are selling the shares to the first, or can I call them initial investors, who can actually sell to somebody else in the secondary market. So the point of interaction of the company usually with investors starts at the primary market when the shares are sold to the very initial shareholder. That initial shareholder can sell those shares to somebody else. Once that happens, that is now in the secondary market. Secondary meaning the shares have changed the hands from the initial shareholder to a new shareholder. Now, this new shareholder is the one that is going to be holding that share. And they can also sell the share to somebody else, depending on how the price is behaving. Now, if that shareholder sells at a profit, we say the shareholder has sold the shares with a capital gain. So you've heard about capital gains tax. Yeah, it is even plotted here and there. If the shareholder sells, we call it capital loss, right? Very important. Now, let me go down to the secondary market. I've already talked about the stock market. So over the counter is a case where the exchange of shares does not happen through a formal exchange like the Nairobi Securities Exchange. So if, for example, you have been a SACCO member, when you want to exit, you cannot bring those shares to the capital markets because, you know, for SACCOs, the freedom of entry and exit. So usually you negotiate with somebody else who is a SACCO member, and then you sell those shares to them at a price you agreed. That is over the counter. It is between counterparties. It is between those parties, and is usually through an agreement with no standardized documentation. This is just defining what I have already said. Primary market is part of the capital market. It deals with the issuance of sale and on sale of securities to investors directly by the issue. Directly meaning the initial time when the issuer or the person who's borrowing or the entity that's borrowing is giving out shares for the first time. Secondary market now is where the exchange happens between the person who had been sold the shares the first time with somebody else who is interested in those shares. Fast forward to capital market instruments. Issuers, as you may have seen earlier, are the people who are borrowing. These are the borrowers, the government, companies, banks, individuals, you know. And then there are those securities. These securities are what we call capital markets instruments. These are the instruments that help you to interact with the market. Then, of course, there is buyers. Buyers are those people who have excess funds. You can see the individuals have excess funds like yourselves here, funds and pension funds. You may have saved funds through your pension company. Then, of course, there are financial institutions. All those are entities that have excess funds. But as I said, sometimes issuers can be buyers and buyers can be issuers, depending on who has the funds. We already talked about common shares, which is the example that I explained. Yeah. And the major difference between common shares and bonds is that you are actually raising capital in both cases. But in the case of shares that we talked about, you are bringing new shareholders into the company and they become part owners of the company, which means if you declare a dividend, if you make a profit, you will share in that profit in the proportional ratio that you have agreed. If you declare losses, then of course there is nothing that the shareholder will get because you made losses, and hopefully in the subsequent years, you'll be able to make some profit and be able to share some dividend. Now, talking about bonds. In the case of bonds, you borrow funds. If we take the same company, you borrow funds from those who have surplus funds. Now, they don't become part owners of your company. Preferred shares, you may have learned this in your financial education. It's slightly different from common shares because preferred shares is an issue where you are, of course, very similar to common shares, only that this time, when you're paying dividend, if one holds preferred shares, it means they are given preference when dividends are paid to common shares. So if, for example, I hold common shares and Mudhoni holds preference shares, when the company is declaring profit, Mudhoni is supposed to be paid earlier than me. Now, usually in the case of a company making losses, for preferred shares, dividends accumulate even when losses are made, and they are paid when profits start being made. Okay, and it's usually the situation, especially when a company is in dire straits, it requires some funding, and it taps on the services of preferential shareholders. Corporate bonds, very similar to treasury or government bonds, only that government bonds are issued by government, corporate bonds are issued by corporates. Then, of course, we have mortgage and asset-backed securities. These are essentially bonds, but they usually focus a lot more on the housing market. So CMA essentially is the regulator of capital markets, just like Central Bank of Kenya is the regulator of commercial banks. Interestingly, we have far more players within capital markets than within the banking sector. The banking sector has around 47 banks. Yeah. So for CMA, we have a clear mission. You can see there, we were created in 1989. We have a vision that you can see there. We have a mission. We are currently trying to review our strategy. Our strategy is coming to an end in June this year. So some of this, especially the vision and mission, might change a little bit, but who we are does not change. So there you go. This is the mandate of the authority, essentially regulating, licensing and supervising capital market intermediaries. We have intermediaries. So if you like, in the banking sector, they have commercial banks. We also have intermediaries. We try to promote market development. We ensure proper conduct of all licensed institutions. We promote investor education, and we also regulate the issuance. And this is one of those very important ones of market products and services. And you can see there's a mention of shares and bonds. Now, a quick one around CMS regulation. You can see it facilitates all those: market integrity, market deepening and diversification, consumer protection, advice to government on capital markets issues, financial inclusion, financial stability, market integrity. These are the regulators. So for a regulator, this is what it is supposed to be doing. Here are what we are calling market intermediaries for your information. I know you may have seen one or two, somewhere around the city center. We have one securities exchange, the Nairobi Securities Exchange. We have a central depository. This is where the securities are safely kept. As I said, capital markets is a fairly organized market, just like a number of other markets. So once you buy the shares, and I had given an example of a company, that information in terms of data has got to be kept somewhere, so that if, for example, I'm selling the shares, that institution recognizes, shares have changed hands, and therefore it updates its records, so then that the funds change hands as the shares are changing hands, so that each of the parties is satisfied within a period of 3 days, because it's usually what we call T+3, which is a trading cycle. We have stockbrokers, investment banks, all those institutions. For capital markets, you don't require collateral. What you require is what we call an information memorandum. If, for example, you are the one borrowing or you are the issuer. So what you do is you put together a very comprehensive document that explains who you are, what you do, who are the directors of the company. We do what we call a fit and proper on that company that is doing an issuance. What are the risks you are facing? What are your products? What are your profits over time? Who are your key customers? Just to gauge whether the price that you're giving per share of your company is equivalent to approximately what you should be in the market. Because again, we don't want you to come to market and you had said that you'll be doing your 2 shillings per share, only for us to realize that you are 0.2. That would be a tragedy. And that is why a lot of that happens. Then there is relatively less costly Issues of cost here, as you may note, if you've gone through, and I'm not trying to promote any market here. If you look at the banking sector, the number of costs that go into purchase. For capital markets, usually the figures are relatively lower. We're not saying that we are not costly, but when you compare, then it becomes something that you can look at. More reliable way of raising capital. So here we are talking about essentially what does it mean to you? How long is it going to take? Realistically speaking, who are the entities you're going to interact with? What are the challenges you're likely to face? How much do you want to raise? And how easily is it going to be for you to be able to access that capital? So that is reliability for you. Then there's challenges of using capital markets. Again, depending on how you look at it, because sometimes preparing those documentations takes quite a bit of time. It is the price that one has to pay, because now that you are not required to submit a collateral, then there is a trade-off. There has to be some background check done to ensure that ultimately we are admitting somebody to the market who is not going to mess things up. So for capital markets, again, there are more disclosures because, again, once you get listed on the main exchange, everybody is going to see your pricing. You take Safaricom, you take East Africa Breweries, for example. You can just take their annual report and you'll be able to know quite a bit on what they are trying to do. Of course, it's not easy to know 100%, but even your competitors can take advantage of the disclosures you're making. And these disclosures are usually necessary to ensure that as you come to market, investors know what they are getting into. Because we say they're borrowers, no, they're the lenders. Now that they are the lenders, they want to have as much information as possible to determine whether their funds are safe. And that is what determines whether or not they're going to give you the money you're asking for. Then there is the issue of returns being a bit volatile. And this is because, again, as I said, you remember the example that I gave, 2 shillings per share. Once you get listed on the market, prices can fluctuate depending on perception of investors, depending on where the company is headed in terms of its products, depending on what information is out there about the directors of that company. There are a number of factors that determine the pricing of a share, and there are also factors of demand and supply of the share. If it is, a fairly rare share, then usually the prices are usually to go up a little bit because the share is not available. Because the more the supply, the lower the price. The lower the supply, the higher the price. So there's that inverse relationship between supply and demand. So what is it that we have learned so far? We have determined that capital markets can help us to raise capital. They can also help us to access capital, depending on which side of the aisle you lie. And apart from mobilizing capital, capital markets play an important role to ease the circulation of capital by ensuring that there is liquidity, right? Liquidity here refers to the frequency at which funds are changing hands, yeah? And as we saw earlier, the rate at which shares can change hands can be fast also sometimes. For example, if you went to the market today, you will be able to purchase Safaricom shares very comfortably, whether it's today or tomorrow, because the share is very liquid and there is always demand and supply. Yeah, and then as such, capital markets can collaborate with either manufacturing or other sectors in order to ensure that capital is available to those who require it. So just this is a typical price list from the Nairobi Securities Exchange, and this was the price list as of the date is right here, as you can see. It is as of 17th May 2023. And these are the companies that are now trading on the secondary market within the Nairobi Securities Exchange. You can see we have a number of them. We have IGATS, we have Kakuzi, we have Kapchorwa, Limuru, T, Sassini, Williamson T. If you check up there, there is what they are calling 52-week high. So this is the highest price this company has reached per share price over the last 52 weeks, right? And this is the lowest price per share that the company has hit for the last 52 weeks. So for example, for Jubilee, which was here, it has hit over the last 52 weeks, which is over the last 1 year. The highest price has been 273. The lowest price has been 142 shillings. The current average price is 180. Right? So as of yesterday, 17th, the bid price is the price at which the share was being sold. The bid price is the price at which the share was being bought. The ask price is the price at which the share was being sold at. You can see here trading status and then something CD. CD means come dividend, meaning the company has declared a dividend and it's currently trading with that dividend, right? And that dividend is usually paid at a certain point. If we go to the notes, and this was Kakuzi here, this is the serial number. It announced the first and final dividend of 24 shillings per share on 22nd March 2023. Books are closing, meaning if you want to benefit from that dividend, you should have been a shareholder before 31st of May, right? The payment date, as you can see there, is 15th June 2023. So somebody buying this share on 1st of June will be buying it ex-dividend, meaning it will not be having dividend with it when it's bought. So you would find this Kakuzi, as we get closer to 31st May, the price of Kakuzi is going to be increasing, somehow, just for investors who are interested in taking up the dividend. And you can see the highest price that Kakuzi has gone is 450. Right? So that tells you, for some people who are buying, they can say, oh, so the share could be bought at 429. If I add 24, does it hit the highest price that the company has gone at? So I could buy this share and then hold, and then maybe sell after the closure date, which was indicated there below, right? So you can see the terms here, especially for status, come dividend, ex-dividend. This is trading without dividend. This is trading with dividend. Things like that. S means suspended, okay? So if we go back to our Jubilee, so you can see Jubilee Holdings. Initially, this indicates that the share price at the time of the IPO was at 5 shillings. Yeah, what we call the par value or par price. Then this is the serial number of the identifier of the company. It's trading with dividend. You can see that's the lowest price. It traded yesterday on 17th. Okay. If you check the highest price it has traded at, you can see and compare, right? And you can go down there and check. So which is the lowest price this company has traded at? And then you check what dividend it announced. Now, there's something interesting here. So you can see there is high. So there was bid ask, the high of the day, the low of the day. The value weighted average price is here, 1150. So this is the average price at which the share traded on 17th. And then there's the previous price, and then the volume. This is the number of shares that traded on 17th at an average price of 11 shillings and 50 cents. So this happens on a daily basis. So you can see there are a lot of transactions happening. So if you check, this column here gives you the shares that traded yesterday, total. Yeah. So if you try to add that, you will get how many shares traded yesterday at the various prices that we have. The total number of shares that traded is 6,294,800. That total there is the same total you can see down here, right? There are 64 counts and it's an Excel file. Now, if you go here, this is still the same price list, but it's a different sheet. You can see here This is the ISN code. This doesn't change. Total number of issued shares is equivalent to the total number of shares that we talked about earlier in the case of Mudhoni and Associates. If, for example, they succeeded in raising the capital, we would be having 75 shares or what 150 shillings as total. So total issued shares would be 75. The market cap would be the price, the average price on the day times the total number of shares that are issued. So for example, if you multiply this by this, you should be able to give you the market cap figure, right? This one tells you market cap has gone up compared to the previous trading session. 10% up or 10% down are the margins that if a share goes beyond 10%, then there's a market close. So because it means that that share has gone up or down by a significant margin. Otherwise, it should stay within the 10% margin. And you can see that, this went up by 12, this 438. So I can quickly take you through the price list of, so for bonds it's slightly different. And as you can see that, the notations are slightly different, but it's the same concept. As you can see there, we have FXD1, 2022 3-year. It means that this is a government bond, FXD. It pays a fixed interest. So when you borrow, you expect a fixed interest within the 3-year period that the government has borrowed from you. And this bond was issued in 2022. It's a 3-year bond. Okay. Reopened means that it was issued earlier. It has been reopened so that then people, more investors can come in. You can see here it was issued on 11th April of 2022. Okay. It's maturing on 7th of April 2025. You can see there, those are the days to maturity. And then, of course, there is the outstanding value in millions. So you can see that the figure is very clearly indicated. This is indicating that the rate at which one is going to receive their return is fixed. This is the rate, okay? Interestingly, it is very hard for you to get this kind of rate in the banking sector unless you put your funds in a fixed income. Yeah, so it's an area that you would want to explore if you're interested in improving your income levels. We usually talk about side hustles. So this is one of those side hustles that doesn't require you to supervise. There's a saying here by a gentleman by the name Miles Kington. He talks about knowledge is about knowing that a tomato is a fruit. And a lot of people know that a tomato is a fruit. And he's saying that wisdom is not putting a tomato in a fruit salad, although we know it's a fruit. Yeah. So I'll be asking the audience why we don't put tomatoes in fruit salad. Yeah. So I'll be asking the audience why we don't put tomatoes in fruit salad.
When there's a lot of clamor for sustainability, and we hear a lot of times they are green bonds, are they just corporate bonds? What is that other extra element that makes them green bonds?
Right. So green bonds are, first of all, are essentially bonds. There's an extra layer added because they're green bonds. Why? Because for green bonds, they are similar to other bonds, only that number one, when you're raising capital to support through a green bond, it means there are specific projects those funds are going to be deployed into. And those projects have to be green, solar, water recycling, reforestation, things like that, right? The other difference, of course, as I said, it's where you're going to use proceeds, but also for most of the issuers, green bonds require you to go through a certain vetting process because there are specific elements of issuance that I have to go through an evaluation before you do an issuance, because there's a bias towards green projects. That's essentially the difference. right? There could be a little more extra cost associated with issuing green bonds, because one, you require what we call a verifier, somebody who will confirm that if you promise that I'm going to issue a green bond, then everything that you've promised you're going to do in terms of complying with requirements of remaining green, you honor or follow that throughout that process, or even in the usage or deployment of proceeds.
How does a lawyer who has been in court day in, day out, really try and understand, okay, I need to see are the company directors doing great? Is the perception of the market wonderful? Am I looking at a financial analyst? Am I looking at your intermediaries? What am I looking at? Because since I do court case, I come here, look at all the directors. Make it easy. Make it easy.
That's a very good question. Huh? I know that we are very busy trying to sort our issues out. Huh? Now, for equities, I think it's good to start small, so then you gain confidence over time as you move. Eh? The first thing I wanted to mention is that we have a number of market intermediaries that can help you to do this. If you go to the CMA website, we have brokers and investment banks. As you may be aware, a broker is an entity or a person who stands in between somebody buying and selling, and then they get a commission out of that process. Okay. So we have brokers, there are about 10 of them in our market. We also have investment banks who are about 14, if I'm not wrong. You can first of all, just approach them, tell them, I want to invest in shares. Please just give me a rundown of, so what do you think? Where should I put my money? And they'll be able to give you information, right? They will take you through the whole process. You'll feel certain. It is very similar to opening an account with a bank, because they require passport size photos and all that. Once you have opened an account, then you are now set up for trading either bonds or shares. For bonds, you can actually even invest directly, but because of the lack of knowledge that you talked about, I think it would be nice for you to approach a broker who would help you to do it. What the broker would do is, first of all, to share with you as much information as possible on, which are the shares I need to buy? Why do you think these are the best shares for me to buy? And now that I share the price list, tell them to be sharing that price list with you every so often. For about maybe 2-3 months, call Justus and ask him, by the way, there's this figure I've seen. I'm seeing this share has gone up. What is happening? I should be able to explain to you what happened, right? Just for you to gain confidence, because again, you require a bit of information, so then you know what you're getting. What I can guarantee you is, number one, in capital markets, especially given the systems that we have in place, so long as you approach and work with licensed entities, you cannot lose your money. At least not all your money, right? You will lose some of your money, especially if the company's price has gone down. That we don't have control over. And the very fact that the price has gone down does not mean that the price won't pick up, because it depends on a number of things. Sometimes we find information has come out that a given company has registered a loss, right? That in itself can affect the price of the share. Let me give you an example. Safaricom, when it was listed for the first time, and I know there could be a few who can bear me witness here, Safaricom was listed at 5 shillings. If you check the price list right now, I haven't checked it, but I believe it should be more than 10 shillings as we speak. That's a double gain. And in the process, you're also getting dividends. The advantage of it all is, now that you don't have all the time to be, monitoring everything, you can outsource that to somebody else. But of course, in the background, you can be checking so then you know what's going on, because usually it is very hard to make money without putting up a bit of effort.
Does it mean the open government, the bond is it open for the public to buy?
So there's currently a 3-year bond that has just been released to the market. Government is trying to get some funds to support its operations. Now, usually for you to invest in that bond, you need to have opened what they call a CDS account. And a CDS account takes minimum 2 to 3 weeks for you to get it once you submit all the documentation that is required. That is for purchase of a bond. So it's the first step you can take. And once you have the account, then you're good to go because you can trade. You can even use your mobile phone. You don't have to use a broker, so long as you have the knowledge on what's happening. The average rate of a 3-year bond right now should be around anything between 10.5 and 11%, right? It's a fairly good rate. Could be a little higher than that because I haven't checked before I came here. But I can tell you for a fact, you will not regret. That I can tell you for a fact.
Okay, so
if you regret, then come to me. I'll be able to explain.
So on the point of regretting, a follow-up question, is there any chances of losing your capital investment on government bonds? I think somebody's trying to be in your corner.
That's a very good question. See, government is considered to be a borrower all the time. Government never, across the world, governments, borrow. Now, we have an interesting situation in a number of countries, including Kenya, right now. And that is why perhaps you're seeing taxes are going up because, unfortunately, there was a bit of, can I call it a very serious, I don't know what words to use, but there was a lot of borrowing. Funds either went or did not go to the projects that they were intended to go to, because you see, usually when government borrows, it says we are borrowing to support our budget. It's not usually expressly put out that this is where the funds are going to go. So it's upon government to decide. Now, it is rare for governments to default. And even when they default, I don't know whether there has been a government that has defaulted on paying the principal amount that was invested. What I'm saying is, it's possible for defaults to happen across, whether it's government or corporate. It is possible because we're in a market, but it rarely happens, right? I can give an example of Ghana, which is facing a serious challenge. Some of the audience may be aware. The government has had to restructure its repayments because it was facing a fairly dire situation in terms of what it was repaying. Because once you've given your funds to the borrower, your assumption is they're going to use those funds in order to grow themselves, so then they can return back whatever they had borrowed. Now, if and when they don't do that, it is regrettable, right? And for governments, it's usually very rare. But I'm not ruling it out that it could happen, but the chances are very remote.
We saw the kind of panic that was there when the government did not manage to meet its target on the infrastructure bond sale. What are your comments?
Sometimes you find the panic, it may be there, but it's not that you are not able to service. My perspective is, I don't think, for example, the Kenya government is not able to service the debt. And here is why. You see, government works in a very mysterious way. Government budget is usually planned 1 year in advance. So all those funds that are supposed to be repaid this year were planned for last year. Okay? And there's no sudden expenditure for government. Okay? And that is why sometimes I fail to understand when one says they have not been able to do one or two things. Government works on structures. And the moment they borrow, they usually have an account of, if you go to the budget of last year, it clearly outlines how much would be borrowed, how much government would raise as revenue, and how it is going to bridge the gap. Now, if that gap is not bridged for whatever reason, they do what we call a supplementary budget, which comes in between to ensure that the figures are reconciled. All those funds are accounted for, and those revenues are collected well in advance. If there's a deficit, there's a bridging of the gap through borrowing. And that is why I cannot understand why one would say, for example, sorry to say, that there are no funds in the coffers and all that. And so if there are no funds in the coffers, then of course we go for the person who has got the funds. We get hold of their ear and then make them pay. Because those funds we should be having a track through the banking sector up until where those funds are. If they bought a building somewhere in Dubai, then let's auction the building and get back the funds. It's slightly different from a corporate organization where a director can run away with a few funds, right? And you can't get hold of them. In government, it's slightly different. And that is why usually we say government paper is risk-free. Yeah. And that's why I say, yes, there could be a bit of one or two challenges, but usually the chances are remote. And in any case, which investments don't have a risk?
Now that we've gone to these financial intermediaries, what kind of repercussions? Assumably, we have seen stockbrokers engage in, can I say, rogue activities. How does the regulator step in, and what is the protection to the investor at that particular point in time?
The role of CMA is usually very clear in terms of what CMA does. And I think you saw in one of the slides, we were saying that we protect investors. You know, brokers and investment banks being part of the financial system, some of them tend to misbehave. But what we have done is from around 2009, we put in place a mechanism where there is a portion of the trading income, if I can call it income, that goes into what we call ICF, Investor Compensation Fund. The fund is currently in the region of 4-point-something billion shillings. It is to take account of compensation of investors in case of a broker going under. At the same time, we are working on a framework to ensure that all investors hold what we call trust accounts, so that in case the broker goes bust, it is their issue, the funds of the investor are still safe.
Thank you so much, Justus. A comment from one of the participants, they've said that they have learned quite a lot and they're very grateful for the knowledge that you have shared with them today.